Unveiling the TGLR ETF, dividend income, capital growth, and your portfolio. Hey everyone, welcome back to Chat ETF. Today we're diving deep into the TGLR ETF, a fund promising dividend income and capital appreciation. But is it the golden ticket to your investment dreams? We'll crack open the TGLR mystery, explore its pros and cons, and see if it fits your portfolio puzzle. Whether you're a dividend seeker or a growth-focused newbie, stick around. We'll uncover the nitty-gritty of TGLR, including its fees, holdings, and if you can replicate it with other options. So grab your favorite coffee, hit that subscribe button, and let's get chatting about TGLR. Question 1. What is TGLR ETF? TGLR, also known as the Laffer-Tengler Equity Income ETF, is an exchange-traded fund, ETF, designed to provide investors with a combination of long-term capital appreciation and dividend income. Question 2. What is the TGLR ETF's primary investment objective? The TGLR ETF's primary investment objective is a combination of long-term capital appreciation and generating income for investors through dividends. Here's a deeper look at this two-pronged approach. Capital appreciation. TGLR aims to see the share price of the ETF itself grow over time. This growth can be achieved through several means. Earnings growth of the underlying holdings. The ETF invests in large-cap companies with the potential to increase their earnings. As these companies become more profitable, their stock prices tend to rise as well. Overall market appreciation. If the general stock market experiences an upswing, the value of TGLR's holdings, and consequently the ETF itself, is likely to benefit. Dividend income. Dividends are a portion of a company's profits that are distributed to shareholders. TGLR focuses on companies with a history of paying and potentially increasing their dividends. By holding these dividend-paying stocks, TGLR generates a stream of income for its investors. This income can be distributed to shareholders as cash payments or reinvested back into the ETF to further compound returns. Prioritization. While both aspects are important, the emphasis leans towards dividend income as the primary objective. Here's why. Focus on high-quality large caps. TGLR invests in established companies with a track record of dividend payouts. These companies prioritize returning value to shareholders through dividends, indicating a focus on income generation. Selection criteria. The fund's managers specifically target stocks with strong potential for dividend growth. This reinforces the priority placed on income generation. Key takeaway. TGLR prioritizes providing investors with a steady stream of dividend income while also aiming for long-term capital appreciation through the underlying holdings. However, it's important to remember that achieving both objectives simultaneously can involve trade-offs. For instance, focusing on high dividend-paying stocks might limit the ETF's potential for explosive growth compared to a purely growth-oriented investment. Question 3. Does the TGLR ETF track a specific index? No, the TGLR ETF does not track a specific index. It is actively managed. Here's a breakdown of the difference between actively and passively managed ETFs to understand why TGLR doesn't track an index. Actively managed ETFs. In TGLR's case, a team of portfolio managers makes investment decisions. They employ a proprietary research model to select stocks and construct the portfolio based on their analysis and judgment. The goal is to outperform a specific benchmark or the broader market by actively choosing what they believe are the most promising investments. Passively managed ETFs. These ETFs passively track a particular market index, such as the SP 500 or the Dow Jones Industrial Average. The fund manager doesn't actively pick stocks. Instead, the ETF holds the same stocks as the underlying index in the same proportion. The aim is to mirror the performance of the index, offering investors exposure to a specific market segment without the need for active selection. Why TGLR doesn't track an index? Since TGLR is actively managed, it has the flexibility to deviate from a predefined index. The fund managers believe their research model and selection process can identify high-quality dividend-paying large-cap stocks that outperform a broad market index. Question 4. If TGLR ETF is actively managed, who is the sub-advisor and what's their investment philosophy? The sub-advisor for the TGLR ETF is Laffer Tengler Investments Incorporated. They are responsible for the day-to-day management of the fund's assets, aligning with the overall investment objectives set by the fund itself. Here's a closer look at Laffer Tengler's investment philosophy as it pertains to TGLR. Focus on high-quality large caps. Laffer Tengler prioritizes investing in established, large-cap companies with a strong track record of financial performance. These companies are generally considered to be more stable and reliable dividend payers. Emphasis on dividend growth. Beyond simply selecting companies with current dividends, Laffer Tengler emphasizes companies with a history of increasing their dividend payouts over time. This focus on dividend growth aligns with TGLR's objective of generating a sustainable stream of income for investors. Data-driven approach with a 12-factor model. Laffer Tengler utilizes a research model that incorporates various factors known to influence a stock's return. This 12-factor model considers aspects like profitability, valuation, market momentum, and quality to identify companies with strong potential for growth and dividend generation. Active management strategy. Laffer Tengler actively manages the TGLR portfolio. This means they continuously research, analyze, and make investment decisions based on their model and market insights. They can add or remove holdings from the ETF as they see fit, aiming to optimize the portfolio's performance and achieve the fund's objectives. Additional notes. While specific details about Laffer Tengler's investment philosophy might not be publicly available, the information provided by the TGLR ETF website and the general focus on high-quality dividend-paying large caps with a data-driven approach gives us a good understanding of their strategy for managing the fund. Question 5. What is the underlying asset class of the TGLR ETF? The underlying asset class of the TGLR ETF is equity. Here's a breakdown of why. Investment in stocks. TGLR invests in a basket of stocks of various large-cap companies. These companies represent ownership in real businesses, making them equity investments. Differentiation from bond and cash ETFs. Unlike bond ETFs that primarily hold debt securities issued by governments or corporations, or cash ETFs that hold short-term treasury bills, TGLR focuses on company ownership through stocks. Additional points. Focus on large-cap stocks. While TGLR invests in equity, it specifically targets large-cap companies. These are well-established, financially stable businesses with a significant market capitalization, total value of outstanding shares. Potential for capital appreciation and dividend income. Equity investments like those held by TGLR offer the potential for both capital appreciation, increase in share price, and dividend income. This aligns with TGLR's stated objectives. Question 6. Does the TGLR ETF invest in domestic or international markets? The TGLR ETF primarily focuses on domestic, U.S., companies. Here's why. Investment objective. The TGLR ETF's objective is to generate income and achieve capital appreciation through investments in high-quality large-cap companies. Large-cap companies in the context of the TGLR ETF likely refer to large, well-established U.S. corporations. Focus on U.S. large caps aligns with dividend growth strategy. Since the core strategy involves established U.S. companies, it aligns with the aim of finding reliable dividend payers. Large U.S. companies often have a long history of paying dividends and potentially increasing them over time. However, there's a possibility of minimal international exposure. Indirect exposure through U.S. MNEs, even if the TGLR ETF doesn't directly invest in international companies, some holdings might be multinational corporations, MNCs, with global operations. A small portion of the ETF's assets could be indirectly invested in international markets through these MNCs. Question 7. What are the key risks associated with the TGLR ETF's investment strategy? The TGLR ETF's investment strategy carries several inherent risks that investors should consider before investing. Here's a breakdown of some key risks to be aware of. Market risk. This is the general risk that the overall stock market will decline in value, potentially causing the TGLR ETF's share price to fall as well. Equity risk. Since TGLR invests in stocks, it is subject to the risks associated with individual companies. A company's performance can be negatively impacted by various factors, leading to a decline in its stock price and potentially affecting the overall value of the ETF. Large cap risk. While large cap companies are generally considered to be more stable than smaller companies, they are not immune to risk. An economic downturn or industry-specific issues could still negatively impact their performance and the TGLR ETF's holdings. Dividend risk. There's no guarantee that companies held by the TGLR ETF will continue to pay dividends or that the dividend payouts will increase as planned. Economic conditions, company performance, and management decisions can all influence dividend policies. Active management risk. The TGLR ETF relies on the skill and judgment of the sub-advisor, Laffer-Tengler Investments, to select and manage the portfolio. Their investment decisions might not always produce the desired results. The ETF's performance may not outperform a benchmark index or the broader market. Additional considerations. Fees and expenses. The TGLR ETF has an expense ratio of 0.95% as of March 8, 2024. This fee eats into returns, and investors should understand its impact on their overall investment performance. Liquidity risk. While TGLR trades on an exchange, there's a slight possibility that the ETF might become less liquid in times of market stress, making it difficult to buy or sell shares quickly at a fair price. Strategies to mitigate risk. Diversification. Consider including the TGLR ETF as part of a broader, diversified portfolio that includes other asset classes like bonds or commodities to help spread risk. Long-term investment horizon. The TGLR ETF is likely suited for investors with a long-term investment horizon who can withstand potential market fluctuations. Understanding investment objectives. Ensure the TGLR ETF's focus on income and capital appreciation aligns with your own investment goals and risk tolerance. Question 8. Does TGLR ETF contribute to portfolio diversification? The TGLR ETF can contribute to portfolio diversification, but to what extent depends on the overall makeup of your portfolio. Here's a breakdown of its potential diversification benefits and limitations. Diversification benefits. Asset class diversification. If your portfolio primarily consists of bonds or cash equivalents, adding the TGLR ETF, an equity ETF, introduces diversification across asset classes. This can help spread risk and potentially improve your portfolio's risk-return profile. Reduced company-specific risk. Since TGLR invests in a basket of large-cap companies, it offers some diversification compared to holding individual stocks. A decline in the performance of one company might be offset by the positive performance of others. Limitations to diversification. Sector concentration. While TGLR might be diversified across multiple companies, it might still have a concentration in certain sectors like technology or financials. If these sectors underperform, it could significantly impact the overall value of the ETF. Limited international exposure. TGLR primarily focuses on U.S. companies. If your portfolio lacks international exposure, adding TGLR might not significantly diversify your geographic holdings. Maximizing diversification with TGLR. Combine with other asset classes. Consider pairing TGLR with ETFs or investments in other asset classes, like international stocks, bonds, or commodities, to create a more well-rounded portfolio with broader diversification. Alternatives for enhanced diversification. Broad market ETFs. If you seek broader diversification within the equity asset class, consider ETFs that track broad market indexes like the S&P 500 or the Total Stock Market Index. These offer exposure to a wider range of companies across various sectors and sizes. Multi-sector ETFs. These ETFs invest in companies across various sectors, offering diversification within the equity asset class without the concentration risk of sector-specific ETFs.